Hi guys. Today we will analyze Kellogg Company stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been an average performer in the overall market. The long and short-term trends are both positive. Strong support levels are around $73 and $71. Next strong support levels are around $67, $61 and $57. Strong resistance level is around $76. Next strong resistance level is around $83. In the last month the stock has been trading between $70 and $76.40 range. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 2.6 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 2% per year, for last 5 years. We see that the average profit margin of the stock has been around 9% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 64% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Kellogg Company: bad, average, and good. First scenario. Kellogg Company will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be low, 1%. Future profit margin would be low, 9%. Future free cash flow to net income rate would be low, 60%. In this case, the fair value of the stock today would be $67. Second scenario. Kellogg Company will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 1.5%. Future profit margin would be average, 9.5%. Future free cash flow to net income rate would be average, 65%. In this case, the fair value of the stock today would be $78. Third scenario. Kellogg Company will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 2%. Future profit margin would be high, 10%. Future free cash flow to net income rate would be high, 70%. In this case, the fair value of the stock today would be $90. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 4.34. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Kellogg Company, analysts forecast growth rate around 2% per year in next 5 years, and future P around 18. Again, I will use 3 different scenarios for Kellogg Company: bad, average, and good. First scenario. Kellogg Company will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be low, 1%. Future P/E would be low, 15. In this case, the fair value of the stock today would be $30. Second scenario. Kellogg Company will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 1.5%. Future PE would be average, 18. In this case, the fair value of the stock today would be $38. Third scenario. Kellogg Company will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 2%. Future PE would be high, 21. In this case, the fair value of the stock today would be $46. As you can see, today the stock is overvalued, $75, even if we expect the company's high performance in future. While the company has a good profitability rating, there are some minor concerns on its financial health. Also, the stock is expected to show a small growth in revenue in the next 5 years, 3% yearly. Keep in mind that Kellogg is planning a split of its business into 3 independent entities. So, it's too risky to buy the stock at these near all-time high levels, due to the uncertainty of the future performance of each of the new business entities. I may consider buying the stock, if the stock drops to $55. I need an extra margin of safety for this stock. Company strengths. The Kellogg Company, doing business as Kellogg's, is an American multinational food manufacturing company. It produces cereal and convenience foods, including crackers and toaster pastries, and markets their products by several well-known brands including Corn Flakes, Rice Krispies, Frosted Flakes, Pringles, and Eggo, and Cheez-It. Kellogg's products are manufactured and marketed in over 180 countries. Kellogg is adapting with cost savings initiatives, productivity improvements, price increases, and updates to its product portfolio. The company is also shifting its geographic focus to emerging markets, and planning to accelerate growth in its plant-based meats. Kellogg has an exceptional dividend history, having increased dividends for 17 consecutive years. The current dividend yield is 3.14%. The company's return on equity of 36%, return on assets of 8% and profit margin of 10% are amongst the best returns of the industry. Risks. Kellogg's biggest problem lies in the stagnation of its revenues. From 2012 to the present there has been virtually no growth, due to its mature business and competitive industry. Free cash flow is likely to remain pressured, as Kellogg faces the need to reinvest more heavily into the business. The company is seeing shortages of materials and labor, as well as disruptions in the supply chain, that are all raising costs. Kellogg is planning a split of its business into 3 independent entities. The 3 different segments are expected to experience different trajectories of growth, which investors should consider and evaluate independently. The HFSS regulations in UK, a ban on multi-buy offers, including buy one get one free, and 3 for 2 offers, may negatively affect Kellogg's business in 2023. The company may also be hurt by negative currency effects. Major recalls and other food safety issues could also have a severe impact on Kellogg's sales and earnings. Intense competition from other branded products and lower-priced private label products. The company has a high debt level. Kellogg is not financially healthy enough, and could expect problems in meeting its short-term obligations. Based on estimates for the next 5 years, the company will show a very small growth in revenue. The revenue will grow by 2 to 4% on average per year. The earnings per share is expected to grow by 4 to 6% on average over the next 5 years. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.